Our next speaker is the influential blogger behind Snarketing, named by the financial brand as the #1 blog for financial services marketers in 2013. He's also now the research director at Cornerstone Advisors. His most recent book, The Smarter Bank, was published just earlier this year. Ron also happens to be a Longhorn himself, with an MBA from the University of Texas at Austin. Is that how you do that? Please join me in welcoming back to his own stomping grounds, Ron Shevlin.
Morning, everybody. Thank you for coming out. I really appreciate this opportunity to share some thoughts and ideas with you, so I appreciate that a lot. And Karen, thank you very much for that introduction. You know, I don't know if you really appreciate how important the introduction is in helping to establish a speaker's credibility with the audience. But to that end, Karen, you failed to mention something that I think would have really helped me establish my credibility with this group. So I'm afraid I'm just going to have to tell you myself. Lindsay Lohan follows me on Twitter. I'm not joking. It's not a fake Lindsay Lohan account. Lindsay Lohan really follows me on Twitter. Now, I have 3 daughters. Their ages are 25, 14, and 20. That's obviously not chronological order. It represents the order in which they are currently human. And I can tell you that there's very little, if anything, I do in my professional or even personal life that helps me establish any credibility with my daughters. But when I showed them and proved to them that Lindsay Lohan is following me on Twitter, yeah, I gained some credibility. Now, having 3 daughters actually does not gain me much credibility as a market researcher. However, I can tell you that when I tell you that there is a new banking consumer out there, I can tell you that thanks to having 3 daughters, I'm living it every day. It's not just based on the research. I am experiencing that new banking consumer. That's her over there on the right. That's the new banking consumer. As you can see, she is young, and as you can see, she is in love with her smartphone. Truth be told, we're all in love with our smartphones, and in fact, we've become addicted to those devices. The New York Times picked up on that not too long ago when they ran an article called "Attached to Technology and Paying a Price." They were reporting on some research that had been done that shows that thanks to our use of technology these days, our brainwave patterns have changed, as have our communication patterns. You might not be able to read what that guy is typing on his iPad, so let me just blow that up for you a little bit. But you know, it's not just our love of technology that's changing, and it's not just the use of a mobile device that characterizes the new banking consumer. Gen Y is the most financially engaged generation. Over the past couple of years, I've conducted a number of consumer surveys in which I've attempted to define and measure how engaged people are in their financial lives. What I've done is I've defined 15 different activities around financial management. Things like budgeting, expense categorization, tracking interest rates, evaluating the return on your savings and investments, using and accessing educational material. In total, 15 different activities. And what I look at is the frequency with which consumers are performing those activities, and based on that, I compute a score. Based on that score, I categorize consumers into one of 3 groups: the highly engaged, the moderately engaged, and the unengaged. And what I have found is that just 14% of baby boomers and just 1 out of 5 Gen Xers are highly engaged in the management of their financial lives. That percentage, though, jumps to almost 4 out of 10 older Gen Yers, those between the ages of 27 and 34, and dips a little bit to just 33% of younger Gen Yers between 21 and 26. But that dip does not represent a regression back to the previous generations. It's simply a reflection of the fact that they have not hit a life stage that requires them to be as engaged in their financial lives as the 27 to 34-year-olds who are getting married and trying to buy homes and trying to buy cars and trying to save for their new kids' educations 20 years down the road. So I expect that 33% to go much higher. What really characterizes them? Well, of these highly engaged consumers, of those that own a smartphone, and it's a pretty high percentage of them, 3/4 of them use that smartphone to scan products when they go into stores so that they can look up prices, look up reviews, get more information about those products. Half of them are storing coupons on their mobile device or having offers sent to their smartphone. 45% of them are putting their loyalty or reward card information into their smartphones. And more than 4 out of 10 of them are actually having receipts sent to their mobile device. Except, of course, when they shop at CVS, because you can't do mobile payments at CVS. Why are they doing this? Is it simply because they love their mobile devices? That's not it. It's because they want more control over their financial lives, and because they want to make smarter decisions about how they spend their money and how they manage their money. But there's another aspect to this notion of engagement that's characterizing the new banking consumer, and it is their desire for advice. I'm not talking about stock picking advice, I'm not talking about asset allocation, I'm talking about advice about everyday kinds of things, like what kind of financial products and services are best for me? Who are the best providers? How do I select those providers? Where can I get the best deals on things? How does my spending compare to everybody else? And if it's out of whack, what do I do about it? This is the kind of advice they're looking for. Now, when that young banking consumer, that new banking consumer, walks down the street, sees a pair of shoes she likes in the window, what does she do? Takes out the smartphone, takes a picture of it. Now, she may simply be taking a picture because she wants to post it on Facebook, Instagram, Twitter, Snapchat, and the other 437 social networks that she participates in. But it's also quite possible that she has an interest in buying these pair of shoes. And if she does, she has a number of questions that needs to get answered. First question is, how much do these shoes cost? Now, there is no shortage of tools and technology on the market that can tell her that these are a pair of Jimmy Choo shoes that cost $800. But there aren't a lot of tools and technologies out there that can help her address some of the other questions she has. Like, can I afford this? Sure, there are applications and stuff that will tell her what her account balances are. It might tell her what her credit limits are. But that's not helping her really understand if she can truly afford this purchase, because that requires information about the inflows and outflows to her financial lives. Does she have bills that need to get paid, that are scheduled to be paid this week? Or maybe she has a paycheck that's going to come in. She also would like to know, how should I pay for this? Many consumers have multiple forms of payment. But you know, while you can store multiple cards on Apple Pay or Android Pay, those tools aren't going to tell you which ones to use. They're not going to tell you that maybe you can maximize your reward points using one particular card, or tell you that if you are going to revolve this purchase that your interest rates might be lower on another card, or even tell you that there's another card in which you've got reward points to redeem and pay down the cost of this product. She'd also like to know, can I get a good deal on this pair of shoes? And you better believe that every merchant who's developing a mobile app is going to push offers out to her to tell her that she can get maybe 10% off or 20% off a pair of shoes when she's in the store. But those apps aren't going to tell her that there's a store on the other end of the mall that's offering a deal, or perhaps she can get a better deal for it online. Asking these questions, answering these questions, and making smart decisions about these questions is a core component of a healthy financial life. And the thing that I would like to leave you today with, and if you remember nothing else from my presentation, of course, other than the fact that I'm followed by Lindsay Lohan on Twitter, it's this: that financial health will become the basis of competition in retail banking. That's how important this is. Now, I do need to spend some time today trying to prove this out to you and convince you why this is going to be the case, and explain a little bit more about what basis of competition means. But before I do that, I want to talk a little bit about financial health, and what I'd like to do is make 3 assertions about financial health. The first assertion is that we're talking here about behavior and not literacy. I have got nothing against financial education. I just don't think it really works to change behavior very much. And I don't think we can really measure somebody's financial health by simply pushing more financial education out at them. I think we really have to look and understand that there's a path that goes from education to behaviors to decisions to outcomes. Ultimately, I really believe it's the measure of the outcomes that determine financial health. But because that is so hard for us to get a hold on, we need to work our way back this stream. We're already doing a lot from an education perspective. We now have to provide a lot more tools and technology to enable those behaviors that will drive decisions and outcomes. The second assertion I want to make is that financial health is account independent. Now, to help me explain this concept a little bit, I'd like to play a little game with you. I'm sure you all remember Sesame Street. I bet you most of you spent your childhoods parked in front of the TV screen watching Sesame Street. So you probably remember the skit that they used to do, one of these things is not like the other, right? One of these things. Okay, I'm not going to sing it. I'm not going to sing it. We're going to play a little variation on this game. It's called How Are These Things Similar? I'm going to show you 3 things, and you're going to tell me how they are alike. Ready? Unicorns, fairies, and the underbanked. The answer? They don't exist. There's no such thing as unicorns, there's no such thing as fairies, and there's no such thing as the underbanked. The notion that somehow someone who uses payday loans and check cashing services is worse off or less served than somebody who has a checking account who's running up potentially hundreds, if not thousands of dollars a year in overdraft fees, the notion that that other person is somehow worse off because of that or less served is simply a misguided notion. Now, if it would save me from getting kicked out of here on my rear, I will admit that I do believe in the unbanked. But I might differ a little bit with you in terms of what that really means. The FDIC, in the latest numbers that I saw from them, estimates that about 8% of households in the US are unbanked. In the research that I've done, I've looked at a couple different angles. I looked at not just checking account ownership, but also prepaid card ownership, and specifically prepaid general purpose reloadable cards. Here's what I found in the research that I conducted. 72% of households that I surveyed have a checking account and either had at the time of the survey a prepaid debit card or had one in the 12 months leading up to that survey. Also found, however, that 1 in 5 households had a checking account and a prepaid debit card at that time or within 12 months. 72 plus 20 equals 92%, which leaves us with 8% that are unbanked, just like the FDIC's number. However, I found that that number is split even between those who have a prepaid card and those who don't. And I simply don't consider the folks with a prepaid card to be unbanked. I call them the debanked. Because for the most part, these are, and not all of them, there's no stretch of the imagination is it all of them, but for many of them, these are mainstream consumers who willingly opt out of the traditional banking system. And I'll tell you, if more of that 20% in the upper right-hand corner start migrating down to that bottom right-hand corner, you would be very wrong and very misguided to think that these are somehow underserved or less privileged consumers. They are simply making different choices in terms of how they manage their finances. My point is that we have to stop looking at account ownership as a means of determining financial health. The third assertion I'd like to make about financial health is that it is quantifiable. You know, in the world of physical health, we have no shortage of scores. We know our blood pressure, we know our cholesterol levels. I got thyroid issues, thank you, Mom. And so I know my TSH levels. But in the world of financial services, we don't have a lot of scores. We really have just one score, FICO. And it is not enough. It is a measure of creditworthiness. It is not a measure of financial health. And what we need in the industry is I think of it as a fin score. It's not simply a financial health score. In my mind, it's really about performance. Because I think health has a negative connotation, and this does not apply simply to a segment or a low end of the market. This is about for everybody. Understand how well are they doing in the management of their financial lives. Now, there have been some efforts to create this kind of score. There's a company on the West Coast called FlexScore that I think has done a very good job of developing an overall financial performance score. Brett King's Move-In, one of the things that interested me right from day one about Move-In was Brett's concept of CRED, a score that would measure financial credibility that didn't just provide a score, but would help Move-In determine what products and features a customer would be eligible for. As your CRED score improved, the features you became eligible for improved, and if your CRED score went down, you lost access to those features. KeyBank, a couple of months ago, announced a partnership with Hello Wallet to create a financial health score. And I know Beth Mooney from KeyBank will be here later in the conference, and I'm hoping that she'll talk about that effort. But we don't have that today. And maybe what we need is a number of different scores, one that measures creditworthiness, one that measures debt management, one that measures spending quality. There might be a few different measures that roll up into a single score. But let me tell you something. When we have in the industry a well-accepted and established financial performance score, it will transform financial services. And here's why. The first reason is because it creates moments of opportunity. The marketers in financial services organizations, financial planners, financial guidance counselors are always looking for those triggers, those things that generate an opportunity to send a marketing message or to have a conversation with a consumer, to talk about their financial lives and their financial needs. With a financial performance score that is well established and well accepted by consumers, a certain change in that score, whether it's positive or negative, becomes a trigger for a conversation. The marketers, of course, will use it as a trigger to send an offer, but for those of you providing advice and guidance to consumers, it will become a trigger for a conversation. And the consumer that you are helping will understand that it's a right time to talk because they have accepted that score as a measure of their financial health. This financial performance score will also help tie products and services to the bottom line. Why should somebody use your products or your services from your bank or credit union? Because of how it improves not the bank or credit union's bottom line, but how it improves the consumer's bottom line, that financial performance score. Also helps you tie benefits of an impact of potential activities. Why should you pay off that loan? Why should you pay off a mortgage early? What's the impact of doing this or funding a 401k? It impacts and improves the financial health score, and consumers can see this. And that new banking consumer who is so driven by games and gamification will want to maximize that. It will become a point of competition among consumers. What it will really do is it will help establish a new basis of competition in retail banking. Now, to help understand this better, let's take a little bit of a backwards view a little bit and look at how the basis of competition has changed in retail banking over the years. You know, if you go back 50, 60, maybe even 70 years at this point, the basis of competition in retail banking was location. Back in the 50s, back in the 60s, what was most important in influencing a consumer's choice of products and providers? It was who had the most branches in the best locations, and potentially with the best service in those locations. Every decade since then, location has diminished in importance in driving those decisions. And I know there are folks who think branches are dead, and I don't really care about that argument, because what's important to me is not whether or not there are or aren't branches. What's important to me in this view is how important is it as a driver of decision of who they do business with, and that is continuing to diminish decade over decade. Why? Has nothing to do with technology, the internet, or mobile devices. It has to do with the fact that after World War II, as we became a more affluent society, our creditworthiness improved, and we had more needs for savings and investments. So what happened was rates and fees became a much more important driver of decision of products and providers. In fact, it got to the point that around 2000 or so, we had a lot of conflict in the industry. I talked to a lot of banks and credit unions who say, we don't compete on rates and fees. We compete on the quality of our service. It's simply not that easy. You have to compete somewhat on rates and fees. If you think you compete on rates and don't compete on rates and fees, then go charge 15% for a mortgage and see how much business you get. You simply don't do it. It's a challenge from a strategic perspective. But what's happening as we become more affluent overall as society, and as the management of financial lives becomes so much more important, not just to the affluent, but to everybody, it is becoming way too confusing and difficult to really understand how to evaluate products, providers, and understand this. So what emerges here is that the new basis of competition is performance, not based on rates and fees, not based on quality of service, but how well does that consumer's financial life do? How much you improve? What happens here is that you compete from a bank and credit union perspective on a completely different basis. It's not about having the best service. It's not about having lower rates or better fees. You compete on the basis of who helps the consumer best improve that financial performance score or their financial health. And it's not an assertion anymore, it's quantifiable. But what's happening is that it's becoming incredibly confusing. And it's getting to be even worse over the next couple years. This is a picture that has become very popular in fintech circles. Somebody took a picture or a snapshot of the Wells Fargo homepage that had all the features and products listed at it, and basically aligned all of the new startups, or not all of them, not even close to all of them, a bunch of the new startups and how they align with all the features and choices and products on the Wells Fargo homepage. If you see this picture out somewhere, it usually has the label, the unbundling of a bank. I don't really see it as the unbundling of a bank. I see it as the re-architecting of the industry's hierarchy of needs. Now that's a mouthful and a jumble, and I know you are probably all texting and taking pictures, so I'm going to repeat that. This is not the unbundling of a bank. It's the re-architecting of the industry's hierarchy of needs. Now when I use the term hierarchy of needs, what do you think? Maslow, right? The Maslow hierarchy of needs that goes from food and shelter up to self-actualization. This has actually been updated recently to reflect the fact that Wi-Fi and battery life are much more important. In the banking industry, there is a hierarchy of needs. At the most basic level, it's about security. As a consumer, we want to know that when we put our money in a bank on a Monday night, that it's there on Tuesday. From an industry perspective, we want to make sure that the money we got in the bank doesn't ever get taken out by any number of bad actors in the world, wherever they may be. That's the most basic level of the hierarchy of needs. The next level is about movement. When we write a check, which we don't do anymore, of course, or when we use a credit card or a debit card to make a payment, we want to be sure that that money moves from our account to the account where it's supposed to go to. And at the top level of the hierarchy of needs is performance, that we know that that money was moved on a timely basis, and that the rates and fees we pay for movement and security are in line and produce value. What's happening in the industry with all of these new entrants is that they are basically re-architecting this hierarchy of needs. And this really hit home for me last year when I attended the Sibos conference and sat in on the InnoTribe startup competition. There were 7 finalists. 2 of the finalists, Sixscape and Insignia, were basically creating new tools and technologies to improve security. 2 other finalists, Epiphyte and TransferGo, were creating new ways of moving money across borders. And 2 other finalists, StockSpot, which is a robo-advisor, and Lending Robot, which matches investors to borrowing needs on Lending Club, were really about improving performance. Interestingly, however, none of these 6 companies was the ultimate winner of the competition. The winner of the competition was the firm that's creating the new layer in the hierarchy of needs, APIs, that help connect and integrate all of these layers that are being re-architected in the industry. This is getting really, really confusing. And it's very difficult for consumers to make smarter decisions about their finances. And more importantly, or just as importantly, very difficult for banks to figure out, and credit unions to figure out, what is their role in all of this? What do they do? Are these new firms competing with us? I don't see it that way. I see that there's a new role for banks and credit unions that will emerge. And that role is they will become the HMOs of financial services. Now I know you hate this analogy, because you think, oh, I hate my HMO, they suck, they're evil, they do that. That is a failure of execution, not a failure of intention. Somebody needs to pull this all together for consumers. HMOs do not provide health care, but supposedly not just pay for it, because they don't really pay for it, but help integrate and control, not control, but integrate and guide and help consumers improve their health, their physical health. This is what we need in banking. We need institutions that aren't trying to compete with these small startups, but help to integrate them and focus on the financial health of consumers. And that's why I say financial health is the new basis of competition in banking. It's not about disruption of banks. It's not like they're going to go away in the next 5, 10, or even 20 years. There are going to be winners and losers. There's no question about that in my mind. I'll tell you this, though. Well, I couldn't tell you who is going to win or lose. I can tell you that the winners will be those institutions that become an integral part of their customers' lives, wherever they are. So thank you very much for giving me this opportunity to share these thoughts with you. If you're on Twitter, please connect with me at R. Shevlin. And I really appreciate you guys hearing me out on this. Thank you very much.